we've been on talking a few times about this trade war. You might have heard about it.
Absolutely.
Looks like we're kind of inching towards something. The markets reflected that last week. At Invesco, do you get more bullish on equities, or do you change your equity strategy based on the events of the last couple of days?
Well, I think that in our case, our investment strategy is staying relatively stationary, looking at the incremental progress we've seen on the trade deal. Because a lot of this, I think, has been projected by markets for several months now, which is a delay of the implementation of some of these tariffs that were scheduled for October, along with increased agricultural purchases. So I think this is more of a good first step, as President Trump is saying, phase one. And the important details are likely still to come.
Okay, so you remain optimistic, as per last time, on technology names and consumer discretion. You're not scared off by some of the recent strength in discretionary stocks?
Well, I think when we look at the fundamentals of the market and what's really driving performance to us, it's still more of that cyclical versus defensive argument in favor of cyclicals and more of a growthy type market where those companies that can find ways to grow their revenues faster than the headline rate of GDP growth are still going to be rewarded.
But most of the data indicates that we're seeing a slowdown in the economy. Not a fast one. It's not a major collapse, but a gentle slowing. Won't that hurt the consumer and thus the discretionary stocks?
Well, that's a great point. And I think 2019 has always been a year where we've characterized it as slower growth, but better policy.
It's still growth.
Still growth.
Right. It's
absolutely.
slower growth. It's not, contraction or recession.
Right. So just a slower rate of gains will not be overly harmful to the consumer. And in fact, this better policy backdrop led by the Fed, easing, lowering rates, taking care of the repo market is all really helpful to sustain growth.
Without getting into the weeds of the repo market, I mean, the Fed coming out and basically saying we're going to expand our balance sheet, but don't call it quantitative easing, even though it kind of is, but don't call it that. But shouldn't that make us a little nervous? I mean, if the Fed is saying, don't worry, we've got your back, people are kind of looking around going, why would I need the Fed to have my back?
Well, on the contrary, I think that when we look at what the Fed's actions, both on the headline interest rate side and also in the repo market, is their actions are pointing towards sustaining this expansion. So the Fed's saying...
Can they do that?
They're going to take every tool they've got in order to and use those in order to sustain the expansion. So we think that's a positive sign in the sense that they're willing to take necessary action steps.
So the Fed does sort of have our back, and you think that will expand certain things. And also, outside of the U.S., emerging markets equities. But the emerging markets, it's a big world out there, Tim.
Yeah.
Can you get a little more narrow in where the EM stands?
Sure. Well, I think you're right to characterize EM equities as heterogeneous, right? It's hard to say that all of them are one big category anymore.
We lump them in because of ETFs, but they're not the same.
Right.
Russia's not the same as Brazil or China or anywhere.
Absolutely. I think the big story, though, right now for EM equities broadly has definitely been China, and particularly probably the slowing export side relative to their domestic stimulus or what the Chinese policymakers are doing to help support their economy. That so far seems to be having at least the desired outcome without causing unnecessary inflation or anything else. So we're still constructive on the emerging market complex, and particularly China, even during this trade war.
Okay.